getting through there? Okay, we have answers? You look like you have an answer. No? Why not? Yeah, so we should have an answer. Oops. I can't afford your expensive things. So what do we see? So it's 2.5%? What are you getting there?
Yeah.
Okay, so your Microsoft shares are giving you an $8 gain. And your Pepsi shares a $4 loss. So the new value of your Microsoft is 2,000 shares at 33, giving you a value of 66. And your Pepsi shares 3,000 at 32, giving you a value of 96,000. So the new value of your portfolio is 66,000 plus 96, 162,000. So it's a $4,000 gain from your initial 158. So 4,000 divided by 158 is a 2.5%. If you go through the weights, Microsoft, it's an $8 gain per share. $8 gain on a $25 investment, so that's a 32% return. And a $4 loss on a $36 investment, so that's 11.1% loss.
Okay. How did they get the 0.316, which is the weight? I guess zero.
Okay, the weights, Microsoft, you started with 2,000 shares at 25. And with Pepsi, 3,000 shares at 36, it was worth 158.
Yeah.
So Microsoft's share was 31.6%, which was, if we go back here, 50,000 divided by 158.
Okay.
Okay, so 50,000, the total portfolio at the start was 158,000. The Microsoft shares accounted for 50,000 of that, 2,000 shares at 25 each. So 50,000 divided by 158, that's how we got the 31.6. And Pepsi, 108,000 divided by 158,000, which gave you the remaining 68.4. So either way, you were getting that 2.5% loss. Okay, so the return on Microsoft was $8 per share on a $25 investment. Return on Pepsi was a loss of $4 per share on a $36 per share investment. We have the initial weights, 50 and 158, so we can get to the 2.5%. Let's take a short break and come back and look at volatility or risk.
I'm serious. I hear this stuff.
Can I see the screen? The screen cracked? No? Okay. I thought I saw the screen crack. Yeah, you're kind of great. See, whoa. Let me see this homework assignment. So, what's your name? What's your name again? So, Alicia, you finished the homework for tomorrow? Some kind of assignment? Hmm? Oh, perfect. Foreign exchange. What is A, B, and C? Net return. Net return. Even though it says tomorrow, it's tonight. It's due.
My thing is, if you use text like way, you get a different answer from it. Because I don't know if y'all see that there's a similar question on Google. If you use the Google way, it gives a different answer. textbook. But in the Google way is more straightforward. The textbook is just like all over the place. So like, yeah.
So just say only the textbook. But then, what she said that, remember she said that the textbook we have is not
Accurate. Yeah.
So that's enough.
What page in your textbook? What page in your textbook, remember?
I'm not sure.
Tanya, look at your phone.
But then the exam she gave in class is the exact one that's also in the textbook.
Yeah, because when I use it,
Mhm.
when I use the way from the textbook, that's why I got that.
My issue is the depreciating and the, is it appreciating? Like the calculation for that, which is B and C, is iffy.
No, that's just your foolishness.
It's just, it wasn't clear. It's just clear, frustrated because I'm like, how is it that? It's literally almost the same exact format you put it in now, but you still get a different answer.
Yeah.
I don't know, she gives that question, she could you know the first one. She know why she gives that question, because she hates it.
We should go to her and ask her for her sentence.
Huh?
We should go to her and ask her sentence.
Why want to agree to that? I want to
Agree to what?
So, she told her to be with it, we really literally go to it.
So I'm gonna do.
But this is not I want to test something. What topic is this?
I just like to, oh, okay, no problem.
It's bad.
Okay, so volatility risk. So investors care about return, but also about risk.
Hours behind.
Now, when we combine stocks in a portfolio, some risk is eliminated through diversification. And again, we all know that kind of naively. So there is the traditional notion in life, as in investing, that you don't put all your eggs in one basket. Right? Right? You've heard that? You still say that? Okay, you don't put all your eggs in one basket. You spread it though, you diversify. So ideally then you shouldn't put all your money in one type of investment, you should invest in different things. So basically in traditional portfolio investment, what I tried to do was, can we put a number on that? If you are looking to diversify, you have investments. Is there a metric? Is there any statistic, any number that we can give you that can help you quantify this, make it quote unquote a little more scientific? So we have the average. We've talked about variance, standard deviation. So we now introduce another statistic, the correlation coefficient or the covariance. So covariance or the correlation coefficient, which is a measure of co-movement between two investments. So we now introduce the correlation coefficient or the covariance, which allows us to try to put some numbers. So how do the returns on a pair of investments, two investments, how do they behave relative to each other? So the correlation coefficient is a number that can take on any value from -1 to +1, minus 100% to plus 100%. And it can take on any value. So let's start here. Perfect negative correlation. Perfectly negative. So these two, the returns on these two investments move in opposite directions. So if one goes up by 10%, the other is going to go down by exactly 10%. They are perfectly negatively correlated. So they always move oppositely. So it's, you know, it's your mood in the morning to when this class is about to start. It's a negative correlation. At the other extreme, perfectly positive. They go up together and down together. So that's important. Okay, so negative correlation. If one is up 10%, the other is down 10%. If one is down 5%, the other is up 5%. Perfect positive. If one is up 5%, the other is also up 5%. If one is down 5%, the other is also down 5%. They move in lockstep. Could be zero. They have no relationship with each other. Or somewhere. So, in a common sense way then, what does that mean for diversification? In a common sense way. So if you have your money, if you spread your money across 10 different investments, you're not keeping all your eggs in one basket. So you spread your money across 10 different assets. But the returns on these assets are perfectly positively correlated. Okay, so you followed your common sense notion and you spread your money across the shares of 10 different companies in that team. But the returns on those 10 different companies is perfectly positively correlated. Do you have any diversification? Have you spread your risk at all? Even though you spread your money across 10 different companies? And the answer is no. Because the 10 things you have invested in are going to behave exactly the same. So really, diversification relies on putting your money across assets that are less than perfectly correlated. Because the idea is that you want one to compensate for the other. So you don't just want to hang out with crazy people. You want to have a sane friend or two to balance it out. Which one are you? Are you the crazy friend or the sane friend? You're the same one. Okay, I would say so too. So let's look at this correlation matrix here. So we have how many companies there? Apple, Microsoft, Target, Starbucks, Goodyear, Ford, Berkshire Hathaway. Berkshire Hathaway, does that mean anything to anybody? What is that? Berkshire Hathaway. Okay, so that's a big investment fund. Who's the most, well, I shouldn't say, but one of the most famous investors in the world? But if you were to pick a name of an investor, most famous, one of the more famous, old guy, Warren Buffett. Yes, Buffett. So this is Buffett's fund, Berkshire Hathaway. One of the richer men in the world. He always flies the economy. So let's take how you read this matrix. Apple. So the returns on Apple shares behaves exactly like Apple. So Apple behaves exactly like itself. So hence the correlation coefficient is 100%. Why? Everybody follow that? Apple and Microsoft. So when you look at a correlation, so one of the first things you want to look at is the sign. Okay, the sign. Is it positive or negative? So what is the sign here? Positive. So what does that mean? They tend to move in the same direction. So when one is positive, the other is positive. When one is negative, the other is negative. They tend to move together. So the sign and then the size, the amount. So the correlation comes in 48%. So a strict interpretation of that would say, if Apple is up 10% in terms of returns, then Microsoft would also be up, but by about 4.8%, 48%. Similarly, if Apple is down 10%, would Microsoft be up or down as well? It would be down because the correlation is positive. But down by how much? Down by about 4.8. It would be less and so on. Target to Apple, etc. So, what I think might be useful for you to keep in mind, or one of the ways to think about this outside any number crunching. If you had all of your money in Apple shares, right? And you wanted to add one other stock to your portfolio, and your main motivation, the reason you're doing it, is to reduce the volatility of risk. Your main motivation is to reduce the risk or the volatility. You want to bring down the standard deviation of your portfolio. So you have all your money in Apple, and you want to add one other. You can only have one. And your objective is to lower the risk of your portfolio. Which one would you add? Yes, you would add Berkshire. Why?
Because it has the lowest risk, as well as, I think, the correlation is far off.
Okay, so Berkshire is right, but if your main objective is to lower the risk, then you will pick Berkshire because it has the smallest correlation with Microsoft. Of all the correlations, it's the smallest. Let's think about this another way then. So of these 7 stocks, which one is the riskiest? Okay, Ford is the riskiest. Why would we say Ford is the riskiest? It has the largest standard deviation. So if we want to rank these stocks in terms of risk, the riskiest one is what? Ford. What is the second riskiest? Goodyear, then Apple, then Starbucks, then Microsoft, then Target, then Berkshire. Okay, because the standard deviation is the measure of risk. So let's think about this a little bit. Maybe let's see if I can get a good example. Let's say you had all your money in Ford. Might not work, so that's not. Okay, so we then want to quickly move to look at the mechanics. This should be a familiar formula. This is an FM1, right? To calculate the standard deviation of a portfolio.
Okay.
So this is the formula for the variance of a 2-asset portfolio. You don't have to do it under the exam conditions, but you will get the formula. So the variance of the return on the portfolio, it's a 2-asset portfolio. So it's the percentage of your money invested in asset 1 squared times the standard deviation of asset 1 squared plus the percentage of your money in asset 2 squared times the standard deviation of asset 2 squared plus 2 times the percentage of money in asset 1 times percentage of money in asset 2 times the correlation coefficient between asset 1 and asset 2 times the standard deviation of asset 1 times standard deviation. So let's look at an example here. So using the table below, what is the risk of a portfolio with equal amounts invested in Apple and Microsoft. So equal amounts of money are invested in the shares of Apple and Microsoft, which means that the weights, 50% of your money in Microsoft and 50% in Apple. Okay, so this is our formula here. So what do we know in that formula? Based on the table before there, what do we know? What are the numbers we need to put up? What are the weights? The weights, the W's are what? 0.5, right? 50%, because it says equal amounts, right? So we know that the W's are 0.5, right? If we make Microsoft asset 1, what's the percent of, let's make Apple asset 1. What's the standard deviation of Apple? 41%. The standard deviation of Microsoft is 28%. And what's the correlation between Apple and Microsoft? 0.48. So you actually have everything you need there. Okay, so this would be your calculation. Percentage of money in Apple squared, which is 0.5 squared. Everybody saying that? Percentage of money in Apple squared, which is 0.5 squared, times the standard deviation of Apple squared, which was 0.41 squared. We saw that there. Standard deviation of Apple, 41%. Plus percentage of money in Microsoft squared, 0.5 squared, times the standard deviation of Microsoft, 0.28 squared, plus 2 percentage in Apple, percentage in Microsoft, times the correlation, times the standard deviation. So the standard, the variance of the portfolio is 8.91%, 0.819. And we find the square root 29.9%. Now before you get totally distracted in the mechanics, I want you to sort of think about, so it says if you have half of your money invested in Microsoft and half in Apple, your risk measure or standard deviation is 29.9. So let's keep that in mind. Huh? So let's say you had all of your money in Microsoft, right? What would be the risk of your portfolio? You only have one asset. All of your money is in Microsoft, right? What would be your standard deviation? It would be 28%, right? Everybody seeing that? Okay. If you take half of the money you have in Microsoft and put half of it in Apple, which has a standard deviation of what compared to Microsoft? 41 compared to 28. What would you expect to happen to the standard deviation of your overall portfolio? Because before, you had all your money in Microsoft. And what was your risk number? Your risk was 28%. You take half of the money out of an asset with a risk number of 28%, and you put that half in an asset with a risk number of 41%. What would you expect to happen to your overall risk? Would increase. Okay, but even for your returns, you expect your returns to go up. Would you think it would go up? Would you expect your risk to go up by a lot? A little bit? A moderate amount, somewhere in between? Because Apple is significantly more volatile than Microsoft. Huh? 28% compared to 41% is a big jump, huh?
Yes.
But the calculation that was just done which tells you that a portfolio with half your money in Microsoft and half in Apple has a risk measure of what? 29.9%. That answer should surprise you. Or if we look at it the other way, if you had all of your money in Apple, how much risk were you facing? What was your risk number?
41%.
41%. You take half of the money you had in Apple and you put it in Microsoft, which has a risk number of what? 28, right? So, what would you expect to happen to your risk? You'd expect it to come down from 41 to some smaller number, right? Would you have expected to get it to 29.9? Which is pretty close to the Microsoft risk number, even though you still have half of the money in Apple, which has a much higher risk number. Everybody see that? Why you might not expect that? But again, that's the magic of diversification. By taking half of the money and putting it in an uncorrelated asset, you can actually get a significant amount of risk reduction, even though you still have half of your money in there. So let's see, a little practice with the mechanic. What is the standard, if we take a few minutes, what is the standard deal for a portfolio with equal amounts of money in Apple and Starbucks? We give you a few minutes to work on that. And once you do it a few times, it becomes easy. Huh? No. They're all like that, right? So let's see. Do I have a solution?
Which is illegal, tax illegal, tax avoidance. Which one?
No, I done. Evasion is illegal.
Okay.
Evasion is illegal. That gets you in jail. Apple and Starbucks should be 30.4. You getting that? 30.4. So percentage of money in Apple squared times the standard deviation of the returns on Apple squared plus percentage of money or the weight in Starbucks squared times the standard deviation of Starbucks squared plus 2 times percentage of money in Apple times percentage in Starbucks times the correlation times the standard deviation. So we know the weights equally weighted. So it's 0.5 squared times standard deviation of Apple squared plus percentage of money in Starbucks 0.5 squared times 0.232 squared, which is the standard deviation of Starbucks, plus number 2, 0.5 times 0.5, 0.38 times 0.41. I mean, the order of multiplication doesn't matter. Times 0.32. So the variance is 9.255%, 0.09255.
Okay, I get that. Yeah, okay.
So when we find the standard deviation of that, we get 30.4%. Again, more important than the calculation is to understand the point of diversification. When we come to look at returns and risk, we are in two different worlds. The return on a portfolio, or the expected return, is simply the weighted average of the returns on the individual assets that make up the portfolio. So we saw that earlier in the first half of the lecture. So let me go back to that. What do I mean by that? So when we did the return on the portfolio, right? The return on the portfolio was simply the weighted average of the returns on the individual assets. So you had Microsoft and Pepsi. What was the return on Microsoft? 32%? Return on Pepsi was minus 11. So the return on the portfolio was just the percentage of money in Microsoft times the return on Microsoft plus percentage of money in Pepsi times the return on Pepsi. It was just the weighted average of the returns of the individual assets. So what is very important for you to see is that that is not true with risk. Not the calculators. Okay. So if we look at it here, what's the percentage of the money in Apple? 50%, right? And the standard deviation of Apple is 0.41, right? And the percentage in Starbucks is 0.5. So if we took so what's the weighted average of the standard deviations? 0.5 times 41 is what? 20.5, right?
Oh, 0.049.
So 0.5 times 0.41 plus 0.5, half of 32 is 16. Half of 41 is 20.5. If you add them, that's not your answer. So the return on a portfolio, the risk of a portfolio is not just the weighted average of the risk of the individual assets that make up the portfolio. The way it is for returns, and that's because of the benefit of diversification. Because that correlation is less than 1, you can spread your risk by diversifying. Okay. So, you're gonna have to come back next week, unfortunately. Now, as you, just some kind, again, you should know this, but just, as you add assets, why is your risk coming down? You are getting rid of risk. We can classify risk into 2 buckets, what we call systematic risk, non-systematic risk. So let's take returns as simply being dividends. Why do the dividends of ECAP fluctuate from year to year? Because profits fluctuate, and profits fluctuate because revenues and costs are not the same. But why do your profits vary from year to year? We can put those causes into 2 buckets. Some we call unsystematic. Some, the variation in ECAP's profits year to year, partly driven by factors that are unique to ECAP. Their business model, their brand. Another part, what we call systematic, is driven by what's happening in the wider world and the wider Antiguan economy. And the idea here is that as you add stocks, as you add investments, you can get rid of the unsystematic risk. There are a set of factors, risk factors, that are unique to companies. As you combine them in a portfolio, you spread the risk. So something, ECAP has just hired a very unmanly HR manager, pissing off the staff, productivity is down. But at the same time, ACB has hired a wonderful HR manager. So those 2 risks are canceling out. So unique or unsystematic risk factors, you can get rid of by diversifying. However, no matter how much you diversify, there's an element of risk you can't get away from. That's what we call systematic risk. So what do you see happening here? On this vertical axis, we have the standard deviation. And on the horizontal, we have the number of stocks. So as you add stocks, what happens to your standard deviation initially? It comes down.
Right.
You are getting the benefits of diversification. Why is it coming down? You are getting rid of the unsystematic risk or the diversifiable, the risk that is unique, by mixing and matching. But eventually what happens? You get to a point now as you add more investments, the risk doesn't come down anymore. You're running into a brick wall. You have gotten rid of all of the unsystematic or diversifiable risk. But now you are left with risk that you can't get rid of. Systematic risk, market risk, non-diversifiable risk. Okay, so we have to come back next week. I mean, the compromise, maybe I mean, I don't need to drag you here. Does it help to do it online? Do you prefer that?
Yes.
But I'm not going to give you a study guide, but what I can tell you, so in your exam, you will have, how many questions? So you're going to have a question, so you're going to have a compulsory, so, but the first thing is, everything you see on the exam you will have seen before. So the exam is going to be based on your tutorial sheets. Okay, so there should be nothing you have never seen before. So you'll have a compulsory question, which is approximately 15 to 20 multiple choice covering all the topics in the course.
15 and 20.
Okay, and again, but you would have seen all of these questions before. So that's a compulsory question, so that's worth 20 marks. And then you have, I think, 4 other questions, and you do any two.
But those are essay questions though.
No. So you will have question on capital budgeting.
Okay.
You'll have a question on weighted average cost of capital. You will have a question on risk and return, portfolio theory. And you have a question on behavioral finance, which we'll talk about next week. And that's more of an essay type question. So those are the 5 questions. Start.
It's a basic program.
Okay, so there's a compulsory question of 20 multiple choice or so, which covers all the topics. So you have to do that. And then there are 4 other questions from which you select any 2.
There's multiple choice and two.
So there would be one on behavioral finance, that's one essay type question. Risk and return, capital budgeting, weighted average cost of capital. Those are your 4 questions. And I said everything on the exam you would have seen before.
So the only one that's essay type is the behavioral finance, the other 3.
But the other types of questions,
Might have short ones.
they might have short things requiring you to write something.
The essay,
Huh?
the essay question is probably 20 marks.
20 marks. Yes. All the questions are worth 20 marks.
Yeah, just one essay, right, for that
One question is a full essay question. Okay, so again, I've gone over, apologies. Again, thanks for your time. So do you prefer the class face to face or not? What's your preference? Online?
Online.
Yeah.
I mean, I don't.
What's the preference?
Online.
Okay, so,
Yes, online.
okay. Okay, so again, thanks for your time and
You'd like to be online. You're gonna be online anyway.
and I will try to get you the coursework marks by next week. That should get you.
What stuff, Chad?